Hello, everyone. So today we're going to look at ticker TJX, which is the TJX Companies Incorporated, widely known for owning TJ Maxx, Home Goods, all the that good service stuff. And we can see down here some of theirs: Marmax, Home Goods, TJX Canada, TJX International. And yeah, this is just a retailer, so family apparel, footwear, accessories, a lot of clothing, house stuff, and their whole shtick is kind of that they have good pricing. A lot of these are liquidated items from larger retailers that didn't sell, so they sold at a discount. And now TGX and TJ Maxx and all those similar retailers are passing the savings off to the consumer, which is very enticing in the current economy and the stage of that. So they've been doing quite well. So we're going to take a look at their stock to see maybe if they're at a great valuation or if they still have room to grow. So let's just look at how they've performed. And first, let's throw the moving averages onto this. So something good that we can see is that they had a gold cross way back in 2022. So we'll be coming up on like 2.5 years from that point. And since then, their 50-day moving average has not fell below the 200-day moving average, showing just consistent price appreciation, and that's been pretty steady up. I mean, we saw kind of a close point here, but even a larger divergence as it went further along. So let's compare it to the S&P benchmark a little bit. 5 year, we're outperformed by 58%. 1 year, outperformed by 14%. 6 months, 9%. 3 months, 2.6%. 1 month, 11%. In 5 days, we're outperformed by 2%. So across all of our time frames that we have here, TJ Maxx has outperformed the broad market. They've just done incredibly well, seeing a lot of stock appreciation. So that's great stuff to see nonetheless. And now let's get into some of their details. 179 billion market cap, so a very large company, trading at a 36 PE ratio, which maybe is a little high. You see that their beta is 0.74, so a little less volatility than the normal market, which is interesting. Dividend yield, so they do pay a dividend, 1.05%. And then we obviously have the price spread here in 52 weeks. You can see their price target based on some analysts. It can go as low as $100 and as high as 193. So that's a 100% difference in price. We have a large point of view difference between analysts. But we can see that the average price target is at $171.78. And yeah, that's currently above what they were trading at, so could be potentially good. Consensus rating, strong buy, a 1.43 rating score, in the space on 18 analyst opinions. So that is bullish in itself. You can see insider trading analysis. It's going to say bearish. This is very common with a lot of companies. A lot of internal sales. People get paid with stocks, and obviously they're just going to sell that out. I mean, you got an $8 million sale from an Ernie Erman, but then, I mean, otherwise, a lot of stock grants going on, occasional sales, nothing too crazy. But yeah, I don't really look towards insiders too much. I only use it as maybe a confirmation of a bull case if you see a lot of internal buying. So that's interesting. Let's look at some of their financials. We can see that their market cap here, revenue, shares outstanding, all that good stuff. We'll see that their PE ratio, their forward PE, is decreasing, so that's good to see. But it's not trading at such a high multiple. Yeah, so PE ratio, forward PE coming down, price to book, price to sale, all great stuff. We can see that historically their PE ratio is trading about where it has been in the past, a little high. So maybe the stock price is going a little ahead of itself a little bit. Look at their revenue growth, which is important for calculating their value, kind of consistently between that 6 to 8% growth year over year. Obviously, 2022 saw a large increase because 2021 saw a fair decrease. So a little bit of outliers in that case. Not necessarily sure what happened in those years, but 2023 up 3%, so very modest. 2024 8.5, and 2025 4%. So we've seen some modest appreciation in revenue recently, nothing too crazy. And kind of COVID and before COVID, a lot that was growing, which I imagine COVID probably had a lot of impact on their 2021 earnings, since a lot of things were shut down, such as retailers, because they weren't essential. If you look at the revenue history, and you can see that 2021, I'm guessing it's COVID year, but steadily up and to the right. It seems, I mean, we've seen our revenue growth, and that was kind of all consistent. So it's good to see that's been appreciating and not really wavering too much. We can see that the earnings per share at the same time has stayed pretty good. I mean, 2017, we see a large dip here, but it's kind of regained itself in 2025 since that large dip in 2026. So consistent earning per share growth, we like to see that. Profitability, they have great margins here, 31% gross margin, 13% operating margin, and then net at the end of the day, 9.1%. 59% return on equity, which is great, 13% return on assets, which is good also. So love to see that. You can see a history of their net margin. 2008, they're at 4.21%. 2015, which is the most recent data I guess we pulled, 7.62. So it's been going up. That's good to see. Return on equity has been staying pretty consistently high. And then cash flow, we got free cash flow and operating cash flow here. $4 billion in free cash flow is incredible. Operating cash flow of almost 7 billion is also great. Here's their free cash flow history over time. You can see it's kind of been up and down, which is interesting. This be due to capital expenditures going up and down. I'm sure they're very brick and mortar heavy, so acquiring new places is going to cost a lot of money. And then obviously a lot of that's going to affect their free cash flow margin over time. So we can see that we're trading at about an average 8% free cash flow margin, which isn't necessarily bad at all for a retailer. If you're going to compare that to software, it's going to seem very small, but this is a different beast entirely. 2022 seemed like a large dip, but they've recovered quite a bit, kind of traded at 8%. So then, yeah, we can see our alpha down below, but we kind of summarized that earlier with how they're benchmarking against the market. So overall, very strong financials. So that's great to see. We can look at some of their dividend history here. So 30 years, they paid 117 dividends. And if you're a dividend investor, you're going to love to see this. I mean, this has been pretty steady. They kind of follow, I think it's Apple that's pretty similar to this, where at the end of the year, they'll raise their dividend. Otherwise, they kind of maintain it throughout the year. You'll see like 4 payments of about the same amount, and then it steps up. And they've consistently done it. It seems like since 2015, they've actually steepened their dividend up quite a bit. So, along with price appreciation in the stock, you've seen a lot of dividends being paid out. Yeah, I mean, you can see versus previous year, 13%, 12%, 12%. So they're trading between like a 12 to 13% annual dividend increase, which if you're looking and you're a dividend investor, you believe in the power of that. I mean, that's just great news. You would love to see something like that. I'm not as big of a fan of dividends in terms of evaluating a stock, but if you'd like to see those numbers show up, that's great. And there isn't necessarily a big bull case or bear case in mind when it comes to this kind of thing. It just more or less if their operations can consistently grow. I mean, they've been steadily growing every year. They haven't really had much of turmoil, which is great. When you steadily compound, you're just going to see great returns at the end of the day. But if you're being interrupted, having slower years and all that, obviously it's not going to be as good. And in light of this, you have competitors like Walmart and Target. Walmart's been doing all right. Target has been struggling. So if you're looking in terms of that, people want to shop at TJ Maxx compared to something like Target. And it's definitely due to kind of like the economic factor where money's tight, people are looking for a bargain and they find a bargain, going to TJ Maxx, they see a lot of that value compared to shopping at somewhere like Target, which has a large clothing premium to what you got to spend. You're going to spend $30 on a shirt compared to TJ Maxx, you might spend $8 to $12 or something like that. And at the same time, you know, you're competing with places like, you know, Home Depot and other maybe some boutiques when it comes to buying things for your house because they're home goods line where they just have a bunch of home stuff. Which if you're growing up, that's one of your favorite parts of the store. So I think they got that going for them. Um, Home buying, I would say, slow down, but apartment, you know, these need to be furnished at the same time. So as long as just the living situation, the population increase in the U.S., they have that going on their side as well. We can look at the bearish. Yeah, I'd say that's pretty bearish. Jim Cramer says he likes TJ Maxx. Yeah, I wouldn't be a fan of that. But no, I think all these they're not too bearish of it, quite frankly. I mean, Lowe's pretty strong Q4 earnings, which that's one of their competitors, but I wouldn't say it's necessarily concerning. So we're gonna do a bit of a discounted cash flow analysis here. And we're going to look at a couple of things. So we got to look at their revenue that they're pulling currently over the trailing 12 months, free cash flow margin, and shares outstanding. So we're going to say bear case, free cash flow margin compressed, revenue slows. Average case, I'll just say like what they're currently doing. And then bull case, I say free cash flow margin increases, and then stronger revenue. I'd say those are pretty consistent. I think they have a fair amount going in their favor, so we're going to up the probability on the bull case. I think there's just a stronger chance that they come out on top in the current climate. We look at their free cash flow margin. I would say an 8% is pretty close to what they're trading on average. They have high and low times. So we're going to use that here on the average case. We're going to use an 8%. Bear case, I would say 6%. And then on the bull case, let's say they could even realistically maybe push up to 10%. That's pretty bullish. But I mean, we see down here below, it's not like it's impossible. They exceeded 12% in 2021. And seeing that they've come back from recent years, they could realistically pull that in my mind. And then if we're going to see revenue growth history, we kind of talked about these outlying cases, but they've been kind of consistently growing between 6 to 8%. So let's just assume maybe a 7% in the average case of their stage one growth. I'd say a 5% for bear case. And then, yeah, I mean, you could argue something like a 9% for the bear case. And obviously, we're going to adjust the stage two growth appropriately. That's fair. Let's say something like 6, and then terminal growth rate 3%. And then we're going to change these discount rates a little bit. So all this goes to say that we have some changes in their revenue that we're expected to grow between these situations. And then we have this standard kind of years that we're associating with that. Discounted cash rate, we're going to say bear case, very good market, average case, and average market, and the bull case, the market's been a little softer, so you can discount it at a little bit of a slower rate. So let's run this, kind of see what that's coming out to be. So this is interesting to see. First time I run the calculation, we can see that the current market price is $161. And now if you had these situations exactly, you have a weighted fair value of $113.97, which assumes a 29.5% overvalued stock. Now we can obviously mess with these factors a little bit. I mean, you can argue the bear case is more likely to happen if you wanted to do something like that. Then let's see. I mean, that brings it up very little bit. You kind of, in the bull case, you have to assume high revenue growth. So we could adjust the revenue growth. And that's getting closer, but you really have to kind of get at these numbers. So I would just say, and this is purely my opinion, if you're looking at TJ Maxx, I would say there's better offers out there in the stock market. And when you're running a basic discounted cash flow model and you're seeing that much of an overvalued, you have to see a lot of revenue appreciation. I mean, we saw the PE ratio, although it's coming down, is still very high at the same time. And I'm not sure if there's anything that makes TJ Maxx and the companies necessarily stand out by themselves compared to competitors, although maybe they have a bit of an edge with the pricing, especially in the current climate. But that's to say it's a great company, but maybe it's getting ahead of itself in terms of pricing a little bit. And that's kind of my opinion. This is just based on the numbers that I ran. I like to trust the numbers a lot more. I mean, obviously the story matters and what could potentially happen, but you do have to make some pretty far out assumptions in order to justify the price that it's being traded at today. So thank you for tuning into the video. I thought this has been quite informative. If you liked it, make sure to subscribe and share with your friends. Check out Aurora Financial Pro. The installation will be in the bio if you're interested in it. 10 bucks one-time purchase. So thank you for making it to the end, and make sure to turn to the next video, and I'll talk to you guys later.